Right now, there is this massive, invisible $15 trillion ocean of private money that's fundamentally reshaping everything in our economy. We're talking about everything from your retirement account all the way down to the local car wash. Welcome to This Explainer, where we're going to decode this staggering private capital boom. Now, if you've been watching the markets lately, you've definitely seen the explosive and honestly sometimes concerning headlines around private credit and alternative assets. But to really understand exactly how we got here, we have to pull back. We need to trace about 100 years of financial history. Today, we're drawing on some brilliant historical insights from Alan Waxman, the CEO of Sixth Street, to figure out how the constantly shifting rules of the game dictate the massive market behaviors we are seeing right now.
So here's our roadmap for today's explainer. First, 100 years of financial systems. Second, the rise of private capital. Third, the factory model. Fourth, today's warning signs. And finally, number 5, facing the tiger.
All right, let's jump right into section 1, 100 years of financial systems and how guardrails shape the market.
Think about how our financial guardrails have shifted over the last century. I mean, they've shifted violently. We start back in 1933 with what we'll call System 1. Imagine the absolute terror of the Great Depression. 9,000 banks simply failed. People woke up, walked to their local branch, and their life savings were completely, irrevocably gone. Poof. In response to that unprecedented panic, the Glass-Steagall Act was passed, heavily regulating the industry to make sure that never happened again. Then, you jump forward to 1999. Intense global competitive pressures led to the repeal of Glass-Steagall, and that ushered in System 2. This was an era of massive, unbridled deregulation. And, well, we all know where that led, right? Straight into the terrifying collapse of the 2008 global financial crisis, where the global economy was literally days away from just freezing up entirely. The reaction to that devastating crash gave us System 3, marked by Basel III and Dodd-Frank in 2010, and that represents the heavily regulated, tightly monitored environment we live in today.
Historically, these evolving systems were really just trying to separate two massive, fundamentally different forces: commercial banks and investment banks. Commercial banks take your everyday retail deposits. They're government backstopped by the FDIC, and they naturally have a very low risk appetite, mostly because they're safeguarding the public's literal grocery money. Investment banks, on the other hand, take principal risk, they use extremely high leverage, and they deploy private capital. The health of the entire financial system historically hinges on the absolute separation of these two entities. We have to keep everyday retail deposits completely, totally safe behind a massive firewall, shielding them from the speculative risks taken by investment banks.
Because, let me tell you, when you mix those two worlds, you get a highly predictable, incredibly destructive recipe for disaster. Step 1, an asset-liability mismatch. Step 2, high leverage. Combining mismatched assets and liabilities, like using short-term, everyday retail deposits to fund long-term, 10-year illiquid investments, and then pouring extreme leverage on top of it, that's the ultimate historical cocktail for a financial crisis. It's literally the core common denominator in almost every single major market crash of the last century.
Moving on to Section 2, the rise of private capital and how it filled the void post-2008. $15 trillion. That is a staggering, almost incomprehensible number. Just to put it into perspective for you, $15 trillion is roughly the entire gross domestic product of China. It's enough to buy Apple, Microsoft, Alphabet, Amazon, and Nvidia outright, and you'd still have change left over. After 2008, under System 3, commercial banks were heavily restricted by Basel III. Because these massive banks were suddenly legally constrained on the risks they could take and the leverage they could use, it left this massive, echoing void in the market for risk capital. Businesses still desperately needed to borrow, but the banks just couldn't lend. So private capital stepped in to fill that exact gap, ballooning from around $2 trillion pre-crisis to a massive $15 trillion today.
Now, initially, System 3 worked perfectly. And that's because this massive private capital boom explicitly avoided the historical danger zone. To truly get this, we have to define an asset-liability mismatch. This happens when an investor's long-term, highly illiquid investments are funded by capital that can be quickly withdrawn on very short notice. For the first decade after 2008, private capital completely avoided this terrifying trap. Their long-term, illiquid investments were funded by equally long-term, locked-up institutional money. We're talking pension funds and university endowments that didn't need their cash back for 10 or 15 years. The system was perfectly balanced.
Which brings us to Section 3, the factory model, and the major shift in incentives.
Around 2018, things really started to change. There's a stark difference in behavior between the traditional artisanal investment model and what Alan Waxman calls the factory model. The artisanal model is all about a pure focus on returns, perfectly matched assets, and deeply disciplined underwriting. The factory model, though, it's industrialized fundraising, incredibly rapid capital deployment, and drastically lowered underwriting standards. Imagine an artisan carefully hand-stitching a beautiful, custom saddle for a single client. Now imagine someone kicks down the door and drops an order for 100,000 saddles on their desk by next Tuesday. Absolute panic, right? They can't handcraft them anymore. They literally have to build a factory. This fundamentally changes how they operate, how fast they deploy resources, and inherently how they underwrite risk. The focus shifts entirely from perfection to sheer volume.
So you might be wondering, why did the factory model take over? Why abandon the artisanal approach? Well, the answer is FRE, or fee-related earnings. This is the highly predictable, steady management fee profit left over after a firm's expenses are paid. Wall Street absolutely craves predictable, recurring revenue over volatile, performance-based windfalls. A steady stream of guaranteed management fees, regardless of whether the market actually goes up or down, heavily dictates the valuation of modern publicly traded investment firms. Simply put, the more assets you manage, the higher your guaranteed fee revenue. And the reward for building that predictable fee stream? It is massive. We're talking a 25 to 30 times valuation multiple in the public markets. Investment firms realize that by gathering massive liabilities, meaning raising as much money as humanly possible to scale up their fee-related earnings, they could earn this incredible multiple. So let's slow down and really think about that dynamic, because it aggressively, fundamentally incentivizes scale over quality. The core objective shifted away from generating pure investment returns per unit of risk and pivoted entirely to simply gathering and deploying as much capital as fast as humanly possible.
And that brings us to Section 4. Today's warning signs, looking at the symptoms of the factory model.
The symptoms of this factory model in action are dangerous, incredibly clear, and they're flashing red in today's financial headlines. To keep the factory running and the fees flowing, firms started aggressively targeting the retail wealth channel for fast capital inflows. To entice regular individuals to invest, they started offering quarterly redemptions on fundamentally illiquid private assets. To deploy all this incredibly fast retail cash, they naturally lowered their underwriting standards. They raised capital in highly narrow, single-strategy funds that completely lack the flexibility to adapt to market shifts. And recently, we've seen the inevitable result, redemptions suddenly exceeding the 5% fund limits, effectively trapping people's money. Offering individual wealth investors quarterly liquidity on highly illiquid, long-term private assets basically resurrects that exact terrifying asset-liability mismatch cocktail we talked about from 2008.
You know those headlines you see about halted wealth fund redemptions and trapped capital? Those are just symptoms. The root cause is the behavioral shift toward the factory model. Waxman powerfully emphasizes that these stuck retail assets and paused redemptions are not the disease itself. They are merely a logical symptom of a financial system that actively decided to prioritize massive liability gathering and ultra-rapid deployment over disciplined, careful, artisanal investing.
And finally, Section 5, Facing the Tiger. Personal leadership in a rapidly changing world.
So how do you dynamically prioritize your time in such a chaotic world? Alan Waxman actually maps his entire mind onto two pieces of paper. On his left brain sheet, he tracks his immediate day-to-day execution. We're talking his top 5 strategic priorities, tactical tasks, a massive list of people to call. And brilliantly, he even includes health-focus items. There's something just incredibly humanizing about seeing Take Vitamin D right next to multi-billion-dollar tactical capital deployment strategies, right? Then, on his right brain sheet, he tracks his long-term vision, 25 years of creative themes, expansive business-building ideas, and core leadership philosophies. By literally forcing his brain out onto paper, he guarantees extreme dynamic prioritization. He carefully isolates the daily tactical grind from the deep, long-term creative thinking required to actually build an enduring legacy.
Waxman explicitly warns us, once you start to prioritize money, fame, and fortune, that's a cup that will never get filled. It keeps getting bigger. When defining success during your prime working years, he strictly warns against the endless, exhausting trap of chasing the factory model's massive payouts. Think about it. If your primary objective in life or business is just the financial multiple or the biggest fund size, you'll inevitably compromise your underwriting, you'll entirely compromise your fundamental purpose, and you'll end up playing a frantic game that you can never, ever truly win. Instead, he enforces a very different, incredibly proactive philosophy. We look at problems head on. We run right at them. He calls this the Face the Tiger philosophy.
In a world of accelerating creative destruction, you simply cannot hide from change. Take the massive systemic disruption we're currently seeing from artificial intelligence. AI is a tiger that is actively upending traditional business models, rewriting the rules of research, and automating entire sectors almost overnight. You cannot put your head in the sand. You have to demand that your team leans into the chaos with extreme proactive adaptability. You don't run from the tiger. You face it head on, look it straight in the eye, and figure out exactly how to evolve.
Which leaves us with this final, really vital question. When the next financial wave hits, will your capital be trapped in the rigid, unyielding factory model? Or will you have the absolute clarity of purpose to face the tiger? As we watch the ongoing massive recalibration of these private markets, ask yourself if your own strategies, both as an investor and as a leader, are dynamically structured to survive the history that is currently repeating itself right in front of us. Thank you for joining me for this explainer. Keep facing the tiger.